In this video, I'm going to show you how you can borrow money at an interest rate substantially lower than you can find at any bank. For investors, cash is an incredibly powerful tool. It provides us with a tremendous amount of flexibility and optionality in our decision making. The problem is when we have too much cash on hand, it can lead to something called cash drag. That's the opportunity cost of returns we could have had if we had invested the cash rather than having it sit idle on the sidelines. So how do we manage this trade-off? On the one hand, wanting the cash for the valuable flexibility it provides us, but on the other hand, not wanting so much cash sitting around that it hurts our long-term returns. Let me throw an alternative out there. What if instead of having cash sit idle on the sidelines, we simply just borrowed cash whenever we needed it? As an example, it's pretty trivial for any investor to head over to any major brokerage and turn on margin borrowing. Margin borrowing allows you to borrow cash using your assets as collateral. Schwab, TD, Pershing, Fidelity, they all offer this feature. But the interest rates can be pretty steep. For context, US Treasury Bill rates today are somewhere around 5.5%. But if you were to go turn on margin borrowing at any of the major RIA brokerage firms, you would see margin rates somewhere between 9 and 14%, depending on how much you're planning to borrow. That's obviously really high and potentially in many cases prohibitively high. But in a minute, we're going to talk about how you can access much, much cheaper borrowing markets. That said, if you need cash in a pinch, it's available. And in fact, in certain scenarios, it may make perfect sense to pay those margin rates if you're just trying to cross a short-term cash flow chasm, particularly in a scenario where selling stocks and bonds to come up with the cash would crystallize gains and create a meaningful tax liability for you. And there are other perfectly valid reasons why you might want to borrow cash. For example, a retiree who's taking frequent cash withdrawals from their portfolio may actually be better off borrowing cash in the short term rather than selling stocks and bonds during a bear market, particularly if their view is that the market is going to turn around. In these cases, if investors borrow the capital and repay it over time, they are in effect reverse dollar cost averaging. It allows them to significantly reduce the risk of realizing those losses at the worst possible time. So borrowing can make complete sense. The question we can ask is, well, is there a way for us to borrow but at substantially lower interest rates? We believe substantially lower rates are available if you're willing to lean into the capital efficient world of derivatives like futures. Now, don't worry, to actually implement this idea in practice, you don't necessarily have to trade the futures contracts, but I do think it's important to understand what's actually happening behind the scenes. As an example, a futures contract on the S&P 500 will provide me with the total return of the S&P 500, but I only have to put up a fraction of the money. If I want $100 of exposure to the S&P 500, I might only have to put up $10 of capital to get that $100 of exposures. Now, because I'm only putting up the $10 of capital, it means I'm implicitly borrowing the other $90. But here's a part that's kind of cool. We're not actually charged an explicit interest rate on that $90 we borrowed. In other words, there's no interest payment that's due. What actually happens is the interest payment is implicit. It's subtracted from the returns of the futures contract. All right, to make things a little clearer, take a look at this graph. What I've done here is I've plotted the growth of $100 invested in the S&P 500 versus $100 invested in S&P 500 futures contracts. We can see that the return of the futures contracts is lower, reflecting the embedded cost of financing. And so if we actually measure the difference between these two return streams, what we'll have effectively captured is that embedded cost of financing. In this next graph, I do exactly that. The green line captures the difference in returns. The bands reflect the returns of 1 to 3 month US Treasuries with different constant premiums added on top. And the reason we do this is to see where that green line falls. And we can see that it falls approximately around the return of 1 to 3 month US Treasuries, plus about a constant 0.4% per year. In other words, that embedded financing cost that we're paying to borrow those $90 has historically been about the yield of 1 to 3 month US Treasuries plus a constant 0.4% per year. Let me put that another way. Historically, you got to borrow at the exact same rate as the US government plus 0.4% per year. All right, wonderful. How does this actually help you? Well, let's say you are a 60-40 investor. 60% of your money is in stocks, 40% is in bonds. What you could do is you could sell down some of your stocks and replace it with exposure in S&P 500 futures. And you could take the cash that's left over and have it sit in short-term US Treasury bills. That T-bill return would help offset the cost of financing that exists in those S&P 500 futures. So when you're not using the cash, you're effectively net neutral. But the cash is now available if and when you need it. By the way, if you're enjoying this video, I would really appreciate it if you could hit those like and subscribe buttons. It really helps the channel grow. And if you have any questions about this video and its content or anything else related to the world of capital efficiency and return stacking, go ahead and leave a comment or send us a message and we will absolutely do our best to get back to you. All right, as with any form of borrowing, this approach is not without its own risks and trade-offs. Besides the operational risk of setting this all up and managing it on an ongoing basis, we have to consider that S&P 500 futures typically receive much worse tax treatment than simple buy and hold equities. Here, I'll simply mention that there are Treasury futures, and Treasury futures, at least as of today, receive somewhat net neutral, if not slightly preferential tax treatment to buy and hold Treasuries. So instead of selling equities to buy, say, S&P 500 futures, you could, in theory, sell some bonds and buy Treasury futures. But you'll also want to consider things like collateral maintenance. Futures are marked to market daily, which means losses can begin to accrue and start to chew through your collateral if you don't keep enough cash on hand. Now, in practice, you don't need to do any of this yourself. There are ETFs and mutual funds that exist today that will implement this concept for you. Consider, for example, an ETF that for every dollar you invest provides you with $1 of exposure to stocks and $1 of exposure to bonds. If you're a 60-40 investor, you could, in theory, sell 10% of your stocks and 10% of your bonds and buy 10% exposure to this ETF. That remaining 10% capital available could be invested in short-term T-bills, ready to deploy whenever you need to draw on it. And when you do deploy it, you're effectively borrowing that money at the incredibly low interest rates embedded in futures markets. Okay, adult swim time. Because once you really internalize this concept, you realize there's all sorts of financing trade-offs you can start to make in your life. For example, according to bankrate.com, the average 30-year fixed mortgage is coming in at 7.9% today. In theory, an investor could sell down some of their stocks and bonds and replace that exposure with capital-efficient instruments like futures and use that cash to increase the down payment on whatever home they're purchasing. In doing so, they're effectively swapping their borrowing rate from the 8% mortgage to whatever the rate is embedded in the futures contracts. Now, there are, of course, plenty of trade-offs to consider here. For example, we probably don't want to do this if selling those assets is going to create a really large tax liability. Conversely, US investors will want to make sure they fully take into account the tax deductions that are available to them from the mortgage interest payments. But if we're concerned about cash flow, reducing the mortgage size helps reduce the explicit mortgage payments we have to make and converts them into implicit payments that show up in the returns of our investments. You might also ask yourself, well, what if we take that cash that's available and invest it somewhere else? And that's exactly what we were just discussing with our example in a house, but you could also consider a variety of other investments. And if you're asking yourself that, you've effectively hit on the core idea of return stacking. With return stacking, we're effectively trying to replace core stock and bond exposure with capital efficient instruments like futures so that we can free up cash and use it to invest in different, hopefully diversifying alternative asset classes and investment strategies. What this does, in effect, is it takes the returns of those investments and stacks them on top of our core stocks and bonds, minus the cost of financing. And again, this isn't something you have to do explicitly. Pre-stack solutions now exist that allow you to tap into this idea without you ever having to manage derivatives yourself. So if you want to learn more about return stacking, you can head over to returnstack.com. Until next time, happy stacking.